The conventional Bancor V1 style design sort of underpins its general assumption that there exists a market for these things, even if that's just the AMM itself, and that there is an enormous amount of active participation in that specific asset. Where the AMM idea kind of falls over is when you've got a single asset that is interesting to only a handful of people. And this could be very large amounts of value, but if you don't have hundreds of thousands of different people pushing the thing around, then the AMM design kind of fails. The reason why Carbon was designed was because I wanted to build something that was a much closer analog of something like eBay, which is a totally reasonable way to run an asynchronous market. One that doesn't prescribe that if you buy something at a certain price, you're then obligated to sell it back to the market at roughly the same price minus some delta, which in credit markets, I stipulate that when someone wants to buy something, they really want to buy it. When that purchase happens, they might be very upset if someone then backran their transaction after acquiring an asset at the price that they wanted to acquire it at. And this is exactly what an AMM requires of you. If you don't withdraw your liquidity after a certain trade is processed, then it's up to other market participants to then decide whether or not the transaction is going to hold, or if someone else is going to come along and then take the trade that you just processed in the opposite direction. The ability to settle a trade once is something that private credit markets actually benefit from because they don't want to relinquish the thing that they brought back to the market so quickly.